Okay, hello everyone. Give me a moment. Okay, so it is 5 o'clock here in Singapore. So I'm gonna start. Hey everyone, once again, welcome to today's exclusive webinar brought to you by Vantage. Okay, so our topic for today will be energy shocks, oil, gas, and market volatility. So before I start, I just want to find out how's everyone doing? How are you guys? Okay, where are you guys tuning in from today? Please drop your country and your city in the chat box. Okay, I always love seeing how global our trading community is. We usually have traders joining in from Malaysia, Singapore, Indonesia, Vietnam, Australia, and even as far as Europe and Middle East. I just want to find out who's here with me today. And so just let me know. Don't be shy. Interact with me in the chat box, okay? Sweden, nice. Yes, I know I asked. Thank you. Australia, Philippines. Nice. Mexico. Wow. Okay, nice. Okay, so once again, this webinar is going to be very interactive, so don't be shy. If something resonates with you, just let me know in the chat box. If you have a question, ask me in the chat box. If you've traded oil before, let me know in the chat box. Just let me know in the chat box. Okay, so if you've ever been caught off guard or have ever encountered any challenges with oil trading, let me know in the chat box. Okay, I want this to be as interactive as possible because, oil isn't just another commodity, it's the lifeline of the global economy. When oil moves, currency moves, inflation changes, and central banks react. So today's topic is, I would say, pretty important to kind of have knowledge on how the economy works. Okay, so over the next hour, we'll unpack how energy market works, what causes those explosive moves, and how traders like us can turn volatility into opportunities. Okay, so if you're ready, let's get started. Again, just a reminder, if you are tuning in from Zoom, you will have more of my attention. I would see your questions very easily. If you are tuning in from Vantage app, just know that there is 1,000 of you on Vantage, more than 1,000 of you tuned in on Vantage app, and I'm sure you guys can see the chat box moving like crazy. The chat box is transparent to everyone. It's moving like crazy. So if you have a question, chances are I will miss your question if you ask me on the Vantage chat box, because every time there's a new message, I get brought down to the bottom of the chat box and I will miss your message. So yeah, I hope you understand. I trade only gold. Okay, gold is another good commodity to trade. I actually trade a lot of gold as well, but not so much of oil. But yeah, let's go through today's topic so we kind of understand the fundamentals of oil and how it affects our economy. Okay, so before we begin, a quick disclaimer. I'm gonna stay here for a minute or two later on, but basically the disclaimer is here to remind you guys that this webinar is for educational purposes only. Okay, everything I will share today is based on analysis, observation, and my own experience as a trader and an analyst. Okay, this is not a signal service or financial advice of any kind. The goal is to help you understand why the markets move the way it does. Okay, and how you can apply that understanding and that knowledge when trading with Vantage. Okay, so trading always involves risk, okay, especially when dealing with volatile assets like oil or gas. So make sure you trade responsibly, manage your exposure wisely, and use today's insights as part of your own informed decision making. Okay, hi Nina, hi Christoph, hi Chris. And there's two Chris today. Okay, hi Grace, hi Jackie, hi, hi Leonard, hi. Okay, yeah, I'm gonna stay here for a minute so you guys can read through the disclaimer. It's very important that I go through the disclaimer with you guys so you don't think this is any kind of investment advice, financial advice, or any sort of that. this is purely for educational purposes, okay? And another risk warning, trading Forex and CFDs, especially if you are trading on margin, carries significant risk and is not suitable for all investors. You may lose more than you initially intended to, okay? So please be cautious. Okay, I'm going to introduce myself. My name is Cassandra. For those who already know me, you have heard this many times. For those who are here for the first time, because there is more than 1,000 of you here, I'm sure there's someone who is here for the first time. My name is Cass. I am an investment analyst at Everest Fortune Group. We are the finalists for the best Forex and best equity research. We are a research firm. We study the markets thoroughly, like a lot. We forecast a lot. We do a lot of back testing. We study strategies. We back test strategies. We study the characteristics of certain charts and whatnot. Okay, so we understand the markets very well. That's basically our entire job. Our entire job is just to understand and study the markets. Okay, other than that, I am a prop trader. What a prop trader does is means that I am funded by multiple companies. So I took a test, I passed those tests, and those companies gave me funds to trade with. How did I pass the test? The test is not as easy as it looks, I think. I was required to do 10% profit within a month. I've done 10% profit within a month multiple times already. And how I did that was to combine a lot of technical analysis. I specialize in technical analysis and a bit of news trading, but I think majority of it is technical analysis. And yeah, a lot of risk management, proper risk management, and a lot of just understanding the markets will help you become very profitable. So yeah, so how I did my 10% a month is not by over trading. It is to take very high quality trades. Last week, I did 2 analysis. That's the entire week, right? Okay, last week there's 5 trading days, Monday to Friday. I did 2 analysis on Monday, which is on ETH/USD and EUR/USD. Both trades gave me a profit of 3%. So in total, I would have made 6% last week, but I didn't take both trades. I only took one trade. I only took the EUR/USD trade. So last week, I ended the week with 3% profit. That's how I managed to do 10% profit on the monthly basis consistently by taking very high quality trades, one very high quality trade a week. Okay, that's how I do it. Okay, my point of sharing this is to tell you guys that you should only be taking high quality stuff backed by research and backed by data and information to make informed decisions, okay? And also the reason for me to share all this with you guys is so that you know the person speaking with you today does come from experience. I'm not just making stuff up, okay? This is based on my own experience. Okay, so our agenda for today, why oil is the lifeblood of the markets. Okay, let's take a quick look. Why it's so central to everything from inflation to interest rate. You see why oil prices often lead economic trends rather than follow them. We'll also look at supply shocks like things like OPEC decisions, production cuts, and how wars in key producing regions like the Middle East or Eastern Europe can send prices skyrocketing overnight. After that, we'll move into demand shocks. What happens when global consumption collapses, like during recessions or pandemics? Oil crashes can be just as dramatic as oil rallies, and we'll unpack both sides of the story. And finally, we'll wrap up with the trading angle, how to trade Brent, WTI, and oil-sensitive currencies such as the Canadian dollars, Norwegian krone, and the Russian ruble. Okay, so by the end of today's session, you'll have somewhat of an understanding. I wouldn't say a full understanding because it's only an hour webinar. I would say you would have kind a bit of an understanding of how energy stocks ripple through global markets and how to trade them strategically and not emotionally. Okay, so why is oil the lifeblood of the markets? Let's start with the basics. Why do we call oil the lifeblood of the global economy, quite literally, because everything from airplanes to ships to trucks to plastic, fertilizers, let me think what else, and even cosmetics, I would say, run on or is made from oil. Okay, so about 90% of global transport energy comes from oil. It's in our fuel, our food production, our packaging, it's everywhere. And that's why when oil prices move, the entire global economy reacts. If oil gets expensive, transportation costs rise, prices climb, production slows down, and suddenly inflation becomes everyone's problem. So even central banks watch oil closely. Rising oil prices can push inflation higher, forcing central banks to raise interest rates. So the oil market directly affects monetary policy, which then impacts forex, bonds, and equities. Whether you live in the US, Singapore, Malaysia, in Europe, you feel it. When you pay more at the petrol station or delivery fee goes up, that's the oil market whispering into your wallet. Okay, so oil isn't just another commodity. It is the heartbeat that pumps energy through every industry. It's the one chart that connects traders, policymakers, and everyday consumers all at once. Okay, so knowing and understanding oil will help you understand the economy better. So I put a demographic here of oil consumption in 2016. And of the 100%, you can see a lot of these major countries consuming oil. Okay, so it is very important to have oil. It is very important. It is what fuels our everyday. Okay, so now let's look at the global web of oil. Who produces it, who consumes it, and who really moves prices. Okay, the top three oil producers today are the United States, Saudi Arabia, and Russia. Okay. Sorry guys, can you guys give me like a minute? I will come back. Mm. Okay, I'm back. I'm so sorry, guys. I just really had to use the bathroom. I had like a quick bathroom break. Sorry about that. Okay, yeah. So again, the three top right now is the US, Saudi Arabia, and Russia. Together, they account for nearly half of global output. And you've got major players like Canada, Iraq, UAE, and Iran, China. Okay, these are all the major players. Okay, so on the other side, the big consumers are countries like the US, okay, China, India, and the entire EU, basically, the European Union. So while producers worry about prices dropping, consumers panic when prices rise. Okay, that constant tug of war keeps oil markets alive 24/7. Okay, so then you also have there's also the OPEC, the Organization of Petroleum Exporting Countries, and its extended group OPEC Plus, which includes Russia. They control around 40%, okay, of global supply and can influence prices just by adjusting output targets. When OPEC announces a production cut, prices often jump within minutes. Okay, can you see how that will help you as a trader? Like if you have this information, then you would know to buy or sell oil. Okay, so here's something that ties oil directly to Forex. Oil is priced in US dollars. Okay, that means when oil prices rise, countries that import oil need to buy more US dollars. Okay, pushing the dollar up. When oil falls, demand for US dollars can soften, okay, helping weaker currencies recover. This system, known as the petrodollar system, is one reason why the US dollar has remained dominant for decades. So a simple OPEC statement in Vienna can end up moving not just oil charts, but US dollar pairs worldwide. In short, oil isn't just about barrels, it's about power, politics, and perception. Okay, so here's something fascinating. Oil doesn't follow the economy. The economy follows oil. Okay, so when oil prices surge, it's usually a sign that demand is strong. Factories are busy, airlines are flying, and economies are growing. But if it spikes too high, it can choke the growth by making everything expensive. That's when central bank steps in to cool things down with higher rates. On the flip side, when oil prices crash during the 2020 pandemic, the signals demand destruction. Planes grounded, cars parked, industries slowing down. A low oil price tells us the world is consuming less energy, which often hits at recession fears. That's why traders, economists, and policymakers all watch oil as a leading indicator for global health. Before inflation data or GDP figures even come out, oil often gives the first clue about where things are headed. There's a saying on trading desk: when oil sneezes, okay, the markets catch a cold. I've heard this many times throughout my entire career, actually. And it's true because energy touches every part of production. Even fluctuation sends ripples across stocks, bonds, currencies, and commodities. So when you're analyzing global markets, whether you trade Forex, indices, or metals, always keep one eye on oil. It's the heartbeat that keeps the global trading economy alive. Okay, so let's talk about supply shocks, OPEC decisions, war, and war in the Middle East. Okay, let's start this section with one word that every oil trader pays attention to, which is OPEC. Okay, OPEC stands for Organization of Petroleum Exporting Countries. I place that in the bottom. Okay, and it's essentially a cartel of major oil producing nations like Saudi Arabia, the UAE, Kuwait, Iraq, and several others. Together, they control roughly 40% of the world's oil supply, which is massive. Okay, in 2016, OPEC expanded to include Russia and several non-member countries, creating what we call now OPEC Plus. Okay, so this alliance is even more powerful and often referred to as the powerhouse, okay, because Russia is one of the top 3 oil producers globally. Think of OPEC as a group that literally controls the world's oil tap. They can turn production on or off depending on market conditions. If oil prices drop too low, OPEC cuts productions to tighten supply and push prices up. If prices rise too fast and threaten global demand, they increase output to cool things down. Every month, OPEC ministers meet in Vienna or via online sessions to review output targets. And those meetings are like mini FOMC events for oil traders. Okay, so one headline from those sessions can make Brent or WTI prices jump from $5 to $10 per barrel within hours. Okay, so there's going to be a lot of volatility when those events happen. So what's interesting is that OPEC decisions are just economic, they're political. Okay, for instance, Saudi Arabia's production policy often aligns with its geopolitical interests or relationships with US and other allies. So as traders, it's not enough to just read the numbers. We also have to read politics behind the barrel. So there's a lot of understanding that you have to do before you can kind of master oil. Okay. So now let's talk about something that has shaped the oil market for decades: war in the Middle East. Okay, so the Middle East is home to more than half of the world's proven oil reserves. Countries like Saudi Arabia, Iran, Iraq, and the UAE produce millions of barrels per day. Okay, so when conflicts break out in that region, the ripple effects reach every corner of the global economy. The key vulnerability here is something called the Strait of Hormuz. I don't know if I'm pronouncing it right. Hormuz. Okay, a narrow passage between Iran and Oman where nearly 20% of the world's oil supply passes every single day. It's like the artery of global energy. If that strait gets blocked, attacked, or even threatened, prices skyrocket. Not necessarily because supply has stopped, but because fear takes over. So history has proven many time during the Gulf War in 1990s. Okay, oil prices doubled in just few months. In 2019, when tanker was attacked in Hamas, prices spiked overnight, even though global production didn't actually fall much. That's the power of perception. The oil market doesn't just supply, it prices risk of supply. So for traders, this means geopolitical awareness is not optional, it's essential. If you know what's happening in the Middle East, whether it's US-Iran tension, OPEC disagreements, or drone strikes on facilities, you can anticipate volatility before it even hits the charts. Because when it comes to oil, one rocket in the wrong place can move the entire market. Okay, so now let's bring it all together. How do you actually read a supply shock like a trader? First, always keep an eye on OPEC announcement and production guidance. Okay, even small comments like "we are considering further cuts" can hint at bullish pressure before an official decision. Traders call this forward guidance, okay, and it often triggers early price positioning. Second, watch weekly inventory data from the EIA, which is the Energy Information Administration. Okay, I put it in that slide so you can reference. And API, American Petroleum Institute. If inventories are falling while OPEC is cutting, that's a clear signal of tightening supply, a potential recipe for a sustained uptrend. Okay. Third, don't ignore shipping and sanctions headlines. Okay, when Russia faced export restrictions or even tankers were rerouted during Red Sea tension, it immediately impacted delivery timelines and prices. The trick is not to trade on rumors, but to trade on confirmation. Wait for the news to break. Okay, see the market reaction and look for the pullback that follows. That's where disciplined traders make their entries. Okay, so another thing to note, supply shocks tend to have short-term volatility but long-term direction. Once production is cut, prices don't immediately drop back. They stay evaluated for weeks or months as the market adjusts. So while the knee-jerk reaction may be messy, the overall trend is usually very clean. Okay, so as a trader, that's where you want to be, in line with the flow, not chasing the spike. Cool. Okay, so we're gonna continue with demand shocks, such as like recessions and the pandemic. So far, does anyone have any questions for me? Okay, so if I'm not, I've got a question here. If I'm not trading oil directly, why should I bother following oil prices? I trade Forex, not commodities. Okay, very good question. That's a very good question. And I love it because most traders think like that. They think that because I am a Forex trader, then I don't really need to know what's happening with oil. Okay, even if you never touch oil, it still affects your Forex trades. Okay, but I mean, of course, it depends on what you're trading. So when oil moves, currency like Canadian dollars, NLK, and RUB, which is the ruble, move with it. Okay, so high oil prices make those countries richer. Their currencies strengthen and oil crashes. When oil crashes, those same currencies weaken. So if you are trading anything to do with an oil-related currency, for example, USD CAD, okay, oil is literally half the story behind that pair. So in short, if you trade Forex, you are trading oil directly. So you just, you might not realize it, but oil does affect Forex one way or another. Okay, how do I actually trade oil on Vantage though? Like, do I buy barrels or something? Okay, no. Very good. No, you don't buy the barrels. You're not buying physical barrels of oil. Okay, you can trade oil on Vantage through CFDs. Okay, that means you're speculating on price movement, not owning the actual assets. Okay, you don't have to own the actual assets. You can go long if you think prices will rise. You can go short if you think prices will fall. The beauty is you can profit both ways if you are trading CFDs, and you don't need to deal with the delivery or shortage or whatever. Just, I think on Vantage, you can search for USD oil. Wait, US oil. That's WTI, or UK oil, which is Brent. Okay, that should be on your Vantage MT4, MT5 platform. Same interface, same tools, just different assets. Okay, so I'm gonna move on if there's no other question. I mean, I don't see any other questions right now, but yeah, I'm gonna move on for now. Okay, so now let's talk about something that every trader remembers, and that's the other kind of shock, which is the demand shock. Can you guys see how price was moving? And I don't know if you guys remember this, but oil prices went into negative in 2020. Okay, so we've seen how oil prices can surge when supply tightens, but what happens when the world stops using energy altogether? That's what we call a demand shock, when consumption suddenly collapses due to an economic slowdown, a recession, or in extreme cases, a global lockdown. Okay, a very good example is in 2020, the pandemic, okay, the COVID pandemic literally stopped the world. Flights were grounded, factories shut down, cities went quiet. For the first time in modern history, the demand for oil crashed so hard that producers ran out of places to store it. Okay, can you imagine there was such an oversupply? So in April of 2020, something completely insane happened. WTI crude went negative, minus $37 a barrel. That means sellers were literally paying buyers to take oil off their hands because storage tanks in Oklahoma, for example, were full. Okay, imagine that, the world drowning in oil, but nobody could use it. That event marked the biggest demand shock in modern market history. It wasn't about supply, it was about the total collapse of usage. Airline burnt 70% less jet fuel, vehicles stayed parked at home, and global trade slowed to a crawl. And this is something traders often forget. Oil doesn't just move because of what's underground, it moves because of what's happening above ground. So in the economy, in people's habits, in business activity, when demand dies, oil prices don't just fall, they free fall. Okay, they really free fall. So I don't know about you guys, but I remember this so clearly. You keep reading it in the news, you keep hearing it. Oil is at negative, whatever it is. And I'm not. I remember in 2020, I wasn't a very savvy investor back then. Neither was I very informed or whatever. But now looking back, if I was there back then, I would definitely have bought oil when it went to negative because I mean, we all know oil prices is definitely going to recover. Okay, so let me just go and look at US oil price right now. Okay, right now it's trading at $57, 57-ish dollars. Okay, so imagine you bought it at the negative 40. Every one that you buy will make a substantial percentage of substantial amount. So there's always trading opportunities everywhere. Okay, so beyond pandemics, let's talk about recession. Those periods where economies slow down, companies cut spending, and consumers tighten their belts. Okay, when growth slows, factories reduce production, shipping demands fall, fewer people travel, and naturally oil consumption drops. It's a domino effect. Energy is one of the first indicators to feel like chill of a slowdown. The beautiful or painful thing about oil is that it reflects the macro temperature of the world. When oil is rising, it usually means economies are hot and running strong. When oil collapses, it's a sign that something bigger is cooling down. During recession, you'll often see oil fall from triple digits down to half that level within months. For example, in 2008, the global financial crisis, oil plunged from $147 to under $40 in less than 6 months. Okay, that wasn't just because of banks collapsing. It was because the global economy literally stopped moving. Here's what happens next when oil crashes, inflation drops because everything becomes cheaper. Fuel, transport, raw materials, then central banks usually cut interest rates to stimulate growth. Okay, that in turn affects currencies. Okay, especially those linked to oil exports like CAD, NOK, and RUB, okay, which is Canadian, the Norwegian, and the Russian ruble. Okay, so when oil prices fall sharply, these currencies tend to weaken too, okay, because their national revenues depend heavily on energy exports. In other words, okay, oil isn't just a commodity, it's an economic thermometer. It tells you how hot or cold the world economy is long before the official data even comes out. Okay, so how do we as traders deal with demand shocks? Because they can look terrifying on the charts, candles collapsing, news headlines screaming, oil crash, panic everywhere. Okay, the first rule is simple. Don't try to catch falling knives. Okay, never, ever. It doesn't matter. It doesn't have to be oil. It doesn't have to, it can be gold, oil, forex, whatever it is. Never ever try to catch a falling knife. When oil collapses due to a demand shock, the downtrend momentum is usually too strong to fight. Trying to buy the dip too early can burn you fast. Instead, let the market show signs of stabilizations first. Okay, so what kind of signs? Watch for demand recovery signals. Reports from the EIA, Energy Information Administration, or IEA, International Energy Agency, showing consumption picking up again, or signs that inventory are starting to draw down instead of build up. Also, that helps. Okay, so also pay attention to economic indicators like PMI, Purchasing Managers Index, or GDP growth data. When these start turning positive again, it usually means, I mean, not all the time, obviously, but usually means industrial activity and energy consumptions are bouncing back. So as traders, okay, we want to buy the recovery, not the panic. Okay, when oil rebounds from a low base, those moves can be massive. We're talking about like 30, 40, or like even as high as 70% rallies within few months. That's how professionals position themselves, by waiting for structure, not gambling on emotion. So another tip is demand shocks often trigger volatility clusters. Big moves up and down within short periods. That's a playground for disciplined traders using volatility tools like ATR to manage stop losses properly. Okay, so what is the moral of the story here? Okay, the moral of the story here is that the markets always overreact in both directions. Extreme fear during collapse, extreme greed during recovery. It doesn't have to be oil, right? It can be anything. That's always the psychology of human. And your edge is to stay calm through both. When everyone is panicking, you just stay calm, and that's how you make money. Okay, so how to trade Brent, WTI, and oil-sensitive currencies like Canadian dollars, Norwegian krone, and the Russian ruble. Let's talk about that. Okay, so all right, now let's get into the fun part, which is how to actually trade oil. First, we need to understand the two main benchmark. Okay, so there is two. One is Brent and WTI. Okay, so think of Brent crude as the global benchmark. It's produced in the North Sea, and it reflects international pricing, especially for Europe, Asia, and Africa. When you hear about geopolitical risks like wars in the Middle East or OPEC production cuts, Brent reacts first. It's more sensitive to international politics and shipping routes, like WTI. Okay? Yeah, so WTI. Sorry, someone is asking what I said. So Brent and WTI. So WTI stands for West Texas Intermediate, I think. Yeah. And Brent, yeah, Brent doesn't have to, it's not acronym for anything, but yeah, but WTI stands for West Texas Intermediate. Okay, so that, right. So Brent is more for like Europe, and WTI is more for the US. Okay, that's why if you go on the charts, there's the UK oil and there's the US oil. Okay, so just remember that the US oil is WTI and Brent is the UK oil. Okay, so WTI, which I'm going to talk about right now, on the other hand, represents US crude. Okay, it's landlocked, stored, and delivered from Oklahoma. Okay, it's more affected by US supply and demand factors like inventory data and domestic production levels. You'll often notice that Brent trades at a slight premium to WTI, usually $2 to $5 higher, because Brent is easier to transport globally and has lower sulfur content, meaning it's sweeter and cheaper to refine. Okay, so traders use both benchmarks as a barometer for global and regional conditions. When geopolitical headlines dominate, Brent moves first. Okay, just remember Brent is UK oil. If you go onto Vantage and you find oil, you just find UK oil. Okay, when US economic data or storage reports dominate, then we are talking about WTI, and WTI will lead. Okay, so in simple terms, if you're watching global tension, follow Brent. If you're watching US demand or Fed policy, follow WTI. Okay. But I mean, if you're looking at both as a whole, they kind of both move in the same direction. They structurally on the charts, they kind of just move in tandem with each other. It's just that, again, WTI usually is slightly higher in price because it is higher it costs more to refine the oil. Okay, so now I'm actually reaching to the end of my webinar. I mean, my slides. So then we'll kind of have like a Q&A session. So this is my last 2 slides, and then we can have a Q&A session about today's topic. But if you guys don't really have any question about today's topic, you don't have to ask me about just oil, because I don't know how many of you are actually oil traders, right? I know there's gonna be a lot of gold traders here. Even I myself, I am a gold trader. So for those, even if you don't have anything related to oil trading or anything oil related, you can just ask me questions regarding trading. I will answer you to the best of my ability. Wow. Yeah. Spend an hour talking about oil, right? I hope you guys are a little bit more informed now about oil. Okay, now let's talk about how oil impacts currencies. Because this is where many traders miss hidden opportunities. Like Muhammad was saying just now, how like if he's trading Forex, why does he need to follow the prices of oil? Because certain Forex pair are very tied to the prices of oil. Okay, so the first one is the Canadian dollars, the CAD, often nicknamed as the Sorry, Cass, I'm confused. WTI is from Texas. Why does USD KZR inversely correlated? Okay, so even though, very good question. Thanks for asking me. Even though the WTI is in Texas, you can see how they still move. Okay, even though like it's in Texas, it still contributes to the overall movement of oil prices. Okay, so it doesn't matter if it's WTI or Brent, or doesn't matter which oil producing country it is, it will still contribute to the overall prices of oil. And therefore, because the Canadian dollars is so tied to the prices of oil, it will still affect the Canadian dollars. I don't know if that answered your question, but yeah. Yeah. So basically, because any kind of movement of oil will affect the Canadian dollars, because Canadian dollars is so tied to it. Okay, let me just explain a bit. Okay, so why is the Canadian dollars nicknamed the petrol currency? Because Canada exports nearly 4 million dollars, 4 million barrels of oil per day, mostly to the US. Okay, when oil prices go up, Canada earns more foreign currency inflows, and that strengthens the Canadian dollar. So even though US has their own oil, okay, it's a very funny thing, right? It's a very funny thing. The Canadian oil is still exported to the US because it is cheaper to refine the oil in the US than it is to refine the oil in Canada. I don't have the answer for that. Why it's cheaper to do that in the US? I think it's because the US already have the facilities, the manufacturing, and the expertise, and Canada didn't set up shop there. So they still export their oil to the US. Okay, and it's very funny because US also exports their oil elsewhere. US exports their own oil elsewhere, and they import the oil from Canada, right? It's very, yeah. It has something to do with the oil quality, because it could be that US is exporting the bad quality oil to overseas, whereas they're keeping the good quality oil and they're taking the good quality oil from Canada as well. Okay, so that's why it affects the Canadian dollars. Anything to do with oil will affect the Canadian dollars because Canada is so tied to the price of oil, as you can see in the chart that I put. Okay, so next we have the Norwegian. I don't know if it's pronounced krone or crony. Is it A krone or B crony? Can you guys let me know in the chat box? I'm just gonna call it krone from now on, okay? So Norway exports Brent crude from the North Sea and its massive sovereign wealth fund. One of the largest in the world is funded by oil revenues. When oil rises, the fund grows and strengthens the NOK. When oil falls, capital inflows slow down and the NOK tends to weaken. And finally, the Russian ruble. Okay, this one is heavily tied to oil and gas export, but it's much riskier because of sanctions, capital controls, and political risk. In recent times, we know that Russia has had a bit of drama happening and a bit of like countries sanctioning them. So in normal conditions, rising oil prices would strengthen the RUB, which is the Russian ruble. But since 2022, which I said recent times, that correlation has been distorted due to sanctions limiting trade. Okay, so as a trader, you want to understand which currencies benefit the oil move when oil moves. Okay, when oil up, the Canadian dollars and okay, RUB strengthens. When oil goes down, then those currencies will weaken. But always factor in context. Geopolitical risks, sanctions, and domestic policies can amplify or mute those effects. Okay. All right, let's this is my last slide. Yep, this is my last slide, and then we can kind of do a Q&A session. Okay, I'm at my last slide. So let's put it all together and, in the actual trading side. The global rule of trading oil or oil-linked currency is trade the trend, not the noise. Oil moves fast and the headlines come and go. So instead of reacting to every OPEC rumor or inventory numbers, focus on where the bigger picture is heading. So a simple but powerful approach to use a combination of I'm suggesting to use a moving average, okay, if you're combining it with technical analysis to identifying trend indicators like the ATR. Okay, this will help you with your stop losses. Okay, so for example, if Brent is trending strongly above the 50 EMA and ATR is rising, volatility confirms momentum. That's when you look for pullbacks to rejoin the trend, not chase it. For oil-linked Forex, use the same logic, but at confluence. Look for alignment between oil price direction, and currency behavior. For example, if oil is breaking resistance and the US dollar/Canadian is forming lower highs, that's your confirmation that Canadian dollar's strength is supported by the commodity trend. Same for the Norwegian krone. If Brent is rallying, the EUR and OK often starts dropping. Okay, so the biggest mistake traders make is to jump in during the headline spike. When volatility is highest and spreads widen, the professionals wait for that first retracement. When fear fades, spreads normalize, and the technicals start to align. You can also use oil as a hedging tool. If you're long USD CAD but worried about a drop in oil, you can hedge with a small position in WTI futures or CFDs. That way, you're managing directional risks across correlated assets. But above all, remember this: volatility is both your opportunity and your biggest threat. Oil markets can move 5 to 10% in a single week. Position sizing, stop discipline, and emotional control matter far more than entry precision. Okay, so when oil moves, it moves the world. Okay, so treat it with respect, trade it with a plan and not with emotion. So I put a picture here that I got online. This is the Forex correlation. Okay, this is an example of a Forex correlation. It will work the same if you're talking about oil correlations to certain currency. Okay, so I'm supposed to wrap this up, but we still have like 7 more minutes. So if you guys have questions, do ask me in the chat box. Oh yeah, by the way, I just suddenly remember this. Canada actually exports 75 to 80% of its crude oil to the US, mainly through pipelines, okay? Okay, the oil, so when oil prices go up, Canada earns a lot of US dollars in those exports, okay? Why do they do this? It's because, yeah, it comes back to like the quality of the oil. Yeah, it comes back to the quality of the oil. Okay, so is it worth checking the US oil and US Canadian side by side? Thank you. Yes. I say this a lot in my webinars actually. If you want to do a correlation of if the Canadian dollar is going up or down, you should pull out US oil next to it to do a correlation, as in when you're doing analysis on USD CAD, you can also do your analysis on US oil because they should be moving in the same direction. They should be moving in the exact same direction. Okay. So in a risk-off environment like a war or crisis, should I go long gold, USD, and oil at the same time? Okay, that is a very good question. It's a very tempting idea. Okay, should you go long for oil, US dollar, and oil at the same time? I know last week we did safe haven currency. Like I said, the US dollar is a safe haven currency. Okay, so to answer you, in pure panic, gold and the US dollar usually rise together. Okay, this is in pure panic. Okay, I'm not talking about everyday situation. I'm talking about in panic. But oil sometimes fall because war means disrupted supply. Okay, so you shouldn't go and buy all three of it unless you first do your research and see if there's any disruption in the supply chain. Okay, but also lower, yeah, there's a lot of factors. So it depends on where the crisis is also. If the conflict is in the Middle East, oil supply spikes. If it's a global financial panic, oil usually drops. Okay, so always ask, is this crisis threatening supply or demand? And I'm talking about oil, okay? You can consider buying gold and US dollars because they usually move up in a panic, but when it comes to oil, you need to go and find out where the panic is happening. So it tells you whether oil will go up or go against gold. Okay. If oil affects inflation, should we also watch oil before major central bank meetings? Yes. Okay, that's a very good question. Yes, you're thinking like okay, that's how a macro trader would think actually. Oil prices, you're the best. Oh, thank you, Nina. Oil prices are one of the first things central banks look at when assessing inflation risk. So rising oil means rising costs and therefore rising inflation and therefore potential rate hikes. So if oil's been rallying for weeks, you can expect hawkish tones from central banks. That's why sometimes even gold or US dollar reacts before CPI data. The market's already pricing in what oil has been signaling. Okay, like you kind of see like, hey, how come they already know what to do even though news is not out yet? It's because they already went ahead and looked at oil. Okay, what about natural gas? Does it move in the same way as oil? Okay, nice. Um, that's a very good question. Not many people ask that. I need to think about I need to think about this, okay? I know that natural gas behaves differently because it's more regional and seasonal. Okay? Natural gas is not like oil. Natural gas is it's seasonal. So Europe's gas prices depend heavily on winter demand and Russia supply routes. Okay, so the US has its own dynamic tied to like domestic production. Okay, so gas and oil sometimes move together, like sometimes during global energy crisis, especially, but not always, not all the time. So gas is like oil's more emotional cousin, I would say. Okay, so it's a smaller market, sharper wings. If you're new, I think my recommendation is actually, I mean, even for me, right, I don't even touch gas. So if you are new or if you've been trading for a long time, whatever it is, I personally would recommend you to master oil first if you are looking to master oil before touching on gas. Okay? Okay, so if you guys have any more questions, I will gladly answer them. If not, I'm just gonna stay for a minute. Okay, I've got another question. So during a recession or demand shock, like you mentioned, do we buy oil at lows and or do we just stay away? Okay, I would have to say during demand shocks, okay, or recessions, okay, don't rush in. Because imagine during COVID, people see prices going to negative and they're just like, oh my God, I need to buy now. Okay, but it went to negative $37. Okay, so when even in shock, even in panic, you should still be using technical analysis. You should still be using other confluences to make your decision. Okay, so when demand collapses, oil usually free falls before it stabilizes. So it's going to free fall. And if it's going to free fall to a zone that is unheard of, then you don't really know what's going to happen. Instead of trying to buy the bottom, I think you can try to look out for recovery and start buying in when it's recovering and not aiming for the bottom. So in my opinion, the best trades happen after the panic, not during the panic. So wait for confirmation, inventories tightening, PMI improving, or price forming higher lows. Okay, so if you jump too early, you're catching a falling knife, like I said, not to catch. Okay, but if you wait for the first rebound, you'll be catching the start of a trend reversal. Okay, so that's all I have for you guys today. Yeah, we ended way earlier than usual because um we're just talking about one topic today. So I hope you guys, kind of have an overview of what's happening with oil. I hope this was informative for you guys. I'll see you guys next week. Next week, we'll have another topic, something to do with fundamental analysis, something to do with the news, something to do with like commodities. Again, I no longer share technical analysis with you guys, but it's okay. Whatever information, whatever topic I touch on every week now, it's very economic heavy. It's very like informative and it's good if you are an investor. Okay, so bye guys. Take care. I will see you guys in a week. Bye. Thanks.